In this segment, we will be discussing the types of instruments used to save and invest your hard-earned money. There are many different factors that come into play when choosing what to invest in, so let's go ahead and get started. What is the difference between saving and investing?
Where investing it actually put your money to work for you, expect returns on it. Saving is when you hold onto your money into a savings account with small interest rate. Investing is when you put it into a CD account. You can invest in real estate.
The rates of return and risk for saving at a bank are usually lower than other forms of investment. Interest-bearing checking and savings accounts are offered by banks, credit unions, as well as savings and loan institutions. If the financial institution where an individual has an account is insured by the Federal Deposit Insurance Corporation or the National Credit Union Administration, that account is insured up to $100,000 by the federal government against failure of the financial institutions. What is a CD?
What you listen to music on?
Here are some examples of common savings vehicles. Certificates of deposit, often referred to as CDs, are purchased for specific amounts of money at a fixed rate of interest for a specified period of time. CDs may be purchased for as little as $500, but generally are priced at $1,000, $5,000, or $10,000. The longer the time frame, the higher the interest rate. CDs cashed in before the maturity date incur interest penalties. Many savers also consider U.S. Treasury securities, including Treasury bills, notes, and bonds. These can be purchased through financial institutions for a fee or at a branch of the Federal Reserve Bank with no added cost. There are many differences between savings and investment vehicles. If you're interested in short-term goals or an emergency fund, your money would be better off in something less risky, such as a savings account or CD. On the other hand, if the objective is more towards long-term growth, you should look into stocks, bonds, and mutual funds. The risk associated with investments is different for each depending on the characteristics. Savings can bring returns through interest paid by a bank or financial institution, while investments, such as stocks, use dividends or capital gains and losses on the product. Both come with their advantages and disadvantages. Saving your money makes it very liquid, which means it is easily accessible to you. But inflation can make your returns decrease to nothing or become negative. Meanwhile, investments usually have returns that outpace inflation, but also come with higher risk. This refers back to the idea that having a potential higher return goes hand in hand with taking on greater risk. Knowing your objectives and what you want your money to do for you is key to choosing the right financial vehicles. How exactly does one control risk? Think of risk like building blocks built on a broad, solid base of financial planning and insurance to protect what you own. You begin with the lowest blocks, which means you first build a strong foundation of support, including a home and money in insured savings accounts and certificates. You proceed to the first investment level after the lowest blocks are secure. As you move up from the base level of building blocks, the levels get narrower, representing the space in your portfolio available for investments that involve greater risk. Once you have a solid base for the first level of building blocks, you're ready to move up and become an investor. One level up is the appropriate place for investment quality government and corporate bonds. Above that, mutual funds that invest in low-risk stocks and also quality individual stocks and bonds are on the same level. Most financial experts would put investment real estate on the next level up. At the very top of the pyramid are aggressive investments that only experienced investors should try. We will discuss some of these products in later segments. In some ways, the building block approach is what is behind the old saying, "It takes money to make money." Over time, saving can build up money. However, investing offers the best way to achieve long-term financial goals. Any discussion of investing must begin with this simple truth. Investing means taking risks. Investment success depends in part on the ability to address those risks without passing up reasonable returns. That is why everyone needs to create a financial investing plan that suits them, and then they need to stick to that plan. It is important that we define how investing differs from savings. Investing means risk. You may lose or make more money than you expected. Higher expected return always implies more risk. Markets demand it. This presentation was made possible by the Secretary of State's office as well as the Investor Protection Trust.